Good morning and welcome to this Tuesday, August 1st, Trading Places Live. Can't believe it's already August, but here we are, August 1st. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. I can't believe July has flown by and we're already into August, starting to head toward the second half of the summer months. Of course, these are not typically great months for the market, but we are in a renewed secular bull market run. I'd be much more concerned about August and September if we were, in the midst of that cyclical bear market that we had to endure last year. If you recall, September was not a very good month. August, actually, from about mid-August on, had a really rough end of the summer. I'm not looking for anything like that, but we probably should lower the bar just a little bit. Certainly not expect what we've seen so far in 2023. I'd be surprised if we keep going up at this rate. Instead, I'd look a little bit more for some consolidation as we get further into the summer. But I do expect a very strong fourth quarter. I believe we're going to go back up to set all-time highs. So I think it could be a very exciting fourth quarter. And I think the question whether we hit all-time highs in the fourth quarter or if we wait until the first quarter, I think that will actually be determined by how we perform over the next 6-7 weeks. Once we get through, or maybe even 8 weeks, once we get through the end of September, if we're still fairly close to where we are right now, or even a little bit higher, then I think we're going to see that all-time high in the fourth quarter. Let's see, lots going on today. Really mostly with earnings. We've got a ton of earnings coming up. Tomorrow we have the ADP employment report. Thursday after the bell, we've got Apple and Amazon both reporting their quarterly results. And then Friday morning, we have the jobs report. So there's the potential for fireworks in one direction or the other. The 10-year Treasury Yield, which we'll take a look at in a minute, trending up again, back up over 4%. The Fed still, contemplating maybe another rate hike. They're not going to really divulge exactly what they're going to do, instead saying that they're more data dependent as we go forward. So lots to deal with. Market has lots to deal with, but that's what the market always has. It always has lots to deal with. There's always reasons why the market should go down, and yet we continue to see, for the most part, the market going up. Let's see. Let's go ahead and start off with that market recap from yesterday. And you can see the Dow Jones Industrial Average up a little bit more than 0.25%. S&P 500 up about, let's call it about between 1 and 0.2%. The NASDAQ 100 barely up, just up fractionally, up just 6 points, which was 0.04%. Mid caps, though, up more than 0.4%, and small caps up about 0.9%. So that money's certainly rotating toward the small caps. And the small caps, I don't know if you are aware, but did make a pretty significant breakout yesterday on the close. I'm anxious to see what kind of follow through we get, if any. We do have futures down a bit. I'll check with those in just a minute. The Dow Jones Transportation Index down about 0.5%. So we saw transports pull back after another big run, another breakout in that area, but we did see a little bit of weakness there yesterday. Energy up to lead the sectors. Energy up almost 2%. Crude oil prices, last time I looked, around $82 a barrel. I haven't looked this morning, but we will in just a second. Real estate up about 0.8%. That was your second best performing industry group, sector. And then healthcare was your laggard. Healthcare dropped about 0.75%. Looking at the individual industry groups, aluminum up more than 4%. We had one of the oil industry groups jumping up almost 3%. Crude oil really making that big comeback. So you can see a nice breakout here, actually, closing back above the 750 level for the first time in the last couple of months. So that was a pretty big breakout there. Furnishings on the other end of the spectrum. And this is what I look for in a bull market. And this is why I believe we are in a bull market. You can see furnishings had been leading the market to the upside, had a really, really strong July, and then just recently pulled back here over the last couple of days. But in a secular bull market, when we see money rotate, it doesn't leave the market. It rotates out of areas that have been hot. We get some profit taking in those areas, and the proceeds get reinvested in other areas of the market, just like we're seeing into materials with the aluminum stocks, or the aluminum index doing better. Many of the oil areas doing much better. So that's what you look for. The S&P 500, when we looked at it, it was actually up yesterday. And we had some areas of the market that have been leading that have not done as well here over the past couple of days and have started to pull back. And yet we continue to power forward in our major indices because those folks that are taking profits in some of the key areas that have been driving the market higher are now turning around and putting their money into some other areas that haven't gotten the attention, like materials, and like energy, like real estate, some of those types of areas. Looking at the 10-year Treasury yield, out this morning, we have, let's see, we will have the July ISM manufacturing index. That will be out, I think, at 9:45 this morning. 46.5 is the estimate there. June was 46. So we're looking for that to just pop up just a little bit. June construction spending, looking a little bit in the rearview mirror. Now it's August, and here we are talking about June construction spending. But it is expected to come in up 0.6%, which was a little bit below the May increase of 0.9%. But those are the key economic reports out today. Again, tomorrow we've got July ADP employment report. And then we've got a couple big earnings reports. This is the big week of earnings, by the way. Thursday is the biggest day of earnings season in terms of the number of companies coming out. And then, of course, throw in some of those mega caps like Apple and Amazon. It's going to be a big day. And then throw in the jobs report on Friday. And we certainly could see some movement in the market here over the next few days. But looking at this 10-year Treasury yield, let me get the update, see where we are. Right now, 4.021. So that is up 6 basis points this morning. 410 is kind of a big level in the near term. I think if we go through 410, there's a pretty decent chance we're going to go up and test that October high above 430. And I don't think the market would like it in the short term. I think if we make that move up through 430, and we do have inflation reports coming out, some big ones, the CPI and PPI, later in August, another week and a half or so. I don't have the dates off the top of my head, but they will be coming up. They're usually around between the 10th and the 15th of the month. So looking at the 10-year Treasury yield, I don't know if the market would handle bad inflation news. I don't think we're going to get bad inflation news, but if we did, that could trigger some of the selling again, being in this August-September period, which we know historically can be a struggle sometimes. That makes me a little concerned. That's one of the things that maybe keeps me up a little bit at night, is just knowing the time of the year we are, the summer. Doesn't always kick in, especially when you're in a secular bull market. So I know maybe I'm sounding like I'm waffling a little bit. Listen, I'm bullish long-term. No doubt about it. I believe we're going higher. It's just a question of, we've been straight up. So are we going to consolidate more or even pull back a little bit? Or do we just keep ignoring everything? I mean, sometimes a bull market just puts its head down and just keeps going. So I'm not in the least waffling in terms of whether the market's going up or down. I believe the market goes higher. The question is, what do we do here in the short term? And I've never been one to say I can tell you every day what the market's going to do. I have no idea what the market's going to do. Sometimes I go to bed, futures are red. I get up next morning, futures are green. We take off in the morning, then we're back down, late morning, and then we rally in the afternoon. Other times, we're down in the morning, then we rally back up and see a little sell-off into the close. Who knows what the market's going to do on an intraday basis? I don't. 60-minute divergences I use to help me a little bit. I think they help to kind of guide you in the short term, but it's really, really hard to get the market right every day. That's just way too much pressure for anyone. But long term, make no mistake about it, I've been pretty clear since June of last year. I'm bullish. Haven't changed. I am longer term bullish. And I think we go a lot higher. All right. Let's take a look at the S&P 500. So S&P 500 continues just to move higher. We do still see a little bit of negative divergence. I wouldn't say this is an overpowering negative divergence. If the S&P 500 had a couple more good days, it could be negated. We could see that negative divergence eliminated. And for those who maybe don't understand what a negative divergence is, I mean, a divergence is when something's going one way and something else is going another way. And so in technical analysis, a divergence, most divergences are price versus some momentum indicator. I use them sometimes with intermarket relationships, but for the most part, most technicians, when we talk about divergences, we're talking about price action going in one direction or the other, in this case, going higher, with momentum indicators going lower or starting to roll over. Because normally the normal behavior in the market is when you're going up, in this case, the PPO, which is my favorite momentum indicator, goes up. And then here you can see when it tried to make the breakout in December, false breakout, and look at that PPO rolling over. So price action, I mean, technically, this one's not a negative divergence because it is based, the PPO is based on closing prices. So we need a close on the S&P 500 that's higher. This was an intraday move. We closed all the way down here at the bottom of this black rectangle. So we closed lower. So there's no negative divergence, but it certainly gives you kind of a signal of, hey, we're trying to make a breakout and the PPO's rolled over. Not a great sign. We end up going back lower. Here we're going up. There's your PPO. Again, no negative divergence because we never got to a higher high, but we did roll over, went back down for a little while. And now we've been in this extended move to the upside. And here we had a slight negative divergence. See the PPO rolled over. Prices actually, we did get a closing high. And the next 3 or 4 days we saw selling. We didn't quite reset the PPO. I like to see a reset back at the center line. I like to see a 50-day test after we get these negative divergences. Never really saw that. Started moving up again late May into the first half of June. Beautiful move up in the PPO. But right here, we had a slightly higher high, lower PPO. Went down for a few days, never got to the 50-day, never reset the PPO. And so when we broke out again, we still kind of have this negative divergence that's kind of hanging around. But in August and September, what if we just go sideways? What if we trend maybe between 4,400 and 4,600? That wouldn't be horrible after the run we've had. That could take care of the negative divergence. 4,400, we'd be down to 50-day moving average. So that's why I'm a little suspect. I mean, I'm not bearish. Don't get me wrong. When I talk about stuff like this, I'm talking more cautious, not bearish. There's a difference in my book. Cautious, when I'm bullish, I'll go through periods when I think the market's going to keep going straight up. And I want to ride it, especially with leveraged ETFs if I can. When I start getting negative divergences, it just tells me the risk is a little higher. Not that we're going to crash, but that we've got a little bit more risk in the market. So do you want to be in a leveraged ETF when there's more risk? Personally, I try to avoid it. So here with the S&P, I'd be careful with the leveraged ETFs there, simply because it's possible. The likelihood, I wouldn't say is 50%, but I'd say it's higher than what we've been experiencing, that we could have a pullback of maybe 3-4%. I don't know. But again, is it going to start today? I was saying the same thing 2 weeks ago. And look at what we've done. The market keeps powering forward. So anyway, tough call on a short-term basis. NASDAQ 100, you can see the divergence, negative divergence much more clearly. Higher prices, lower PPO. PPO still rolling over. We're trying to go higher. Can we break out again? I don't know. This one seems like maybe we could see a little bit more rotation. But we've got Apple and Amazon coming up on Thursday. And whatever happens with that report, if I think both those reports are going to be good, especially Apple. I'll be very surprised if Apple comes up with anything disappointing. I think they're going to blow away the numbers. So if Apple comes out with a good number and Amazon comes out with a good number and we get a gap up and the jobs number is okay, we could see a big gap up on Friday. But does it hold? Because it looks to me like about 5 or 6 of the last 8 trading days, we've seen closes at or beneath the open. So maybe it could be an open on Friday. Be careful, especially if we get a sell-off during the day. That could maybe mark a top in the short term where we go back for a little bit and just kind of fill back toward that 50-day moving average. As you can see, I'm not pounding the table bullish right now. I'm a little bit more cautious near term. IWM, here is the Russell 2000. Now, I actually like the Russell 2000 here. A little bit cautious, the S&P and the NASDAQ, but I like what the IWM is doing. We did make a breakout. We have a very, very slight negative divergence. If we go up again today, I think that'll be eliminated. So I'd be careful, not jumping the gun too quickly here on the Russell 2000. But let me go out. I'm going to show you a little bit longer chart here. Because if you look back, and I'm going to annotate this, I think the high close or the high candle body since April of last year. If I can get this set here. There we go. So the high candle body since this move right here in April, where we gapped up just over 200. If you look at August of last year, and then you look again at February this year, I think it's 197.85 or 197.84 was the high candle body. Yesterday, we closed at 198.71. That candle body, which is either the open or the close, here the close was above. We had the highest candle body since April of 2022. This is a pretty big resistance area to clear, and we did clear it yesterday. So I'm short-term bullish the IWM. Now, sometimes you get these head fakes, but if we go down and hit that 20-day moving average, I'm going to be pretty aggressive on the IWM personally. Just my way I read the charts. Everybody makes their own decision, but that's the way I read the chart. I'm pretty bullish the IWM right now. And I've been talking about the IWM. I know it was back here in, I think it was in March, and I was writing about how we were starting to get a lot of these hollow candles. Money was rotating within the small caps from value to growth. There were some things I was seeing back here. And of course, the QQQ had gone up a lot. The spider had gone up a little, had done better than the IWM. And so a lot of folks were questioning me, saying, well, I don't understand what you're seeing here. IWM, the small caps have been performing horribly. And it was just under the surface stuff that was starting to show things were improving. I mean, look at the AD line, for instance. I mean, when we got to these two highs, look at where the AD line was here versus here. So we had much higher. It just looked like accumulation. Then we're pulling back and we're getting into this area of rotation here. And I had pointed out many of these here. You go down, you consolidate. When you break out, you run. Here, go down, you consolidate. When you break out, you run. Same goes here. Same goes here. Well, this one, not as much. But here was all of this consolidation where I kept saying we need to get through 179, 180. We finally did that, and it's been a nice run up in the small caps. Small caps have been outperforming. Now we're getting another breakout. And for me personally, I think this is a really big deal. So, bull market, a bull market is, you want to see participation everywhere. And there were a lot of folks beginning of the year didn't really believe that we were going to continue running because we didn't have the breadth. There wasn't a lot of groups following. It was just the large cap names. But a lot of times when you're moving out of a bear market, the names, there are certain names that folks gravitate to. Apple, Microsoft, NVIDIA, Tesla. These are the ones that you're going, Alphabet. These are the stocks that you're going to see some pretty decent rotation too early when you're heading into a bull market. I mean, if you think the market's going higher, aren't those some of the names that you want to be in? So I was not overly concerned about the breadth issue, not like a lot of folks were. I believed once we had a big move, we'd see some rotation, we'd see money rotating back into other areas. That's what we've seen. And now we've got that IWM breaking out. And look at the AD line, by the way, new highs. Look, this last move over the last 2 months, a lot of it on some pretty good volume. So there's been money that has been moving into this area as well. So volume trends support this move. The PPO supports this move. I mean, in the past, when we've had these big moves on the PPO, we go right back negative, go up, right back negative, go up, right back negative. Here, we've been going up, we turned down, and then we rallied again. This is the behavior of a bull market, not a bear market. So I like the IWM. Again, could we get a 20-day test? It's possible, especially if the market, is weak in the near term. But I believe we're going a lot higher here. And the part that gets me excited is I think every area is going back to all-time highs. We're getting close already on the Dow, the S&P, and the NASDAQ. But when I look at the IWM, because it's lagged for so long, this breakout, and I look at where we were in November of 2021, folks, we still got another 20% on the IWM before we get back to the November high. If we pull up something like the QQQ, I want you to look at how close we are. Here, we're way up there. So there's still plenty of rotation that can hit and can come into the small caps. Anyway, let's move on to quickly look at the transports, which they've been going up. The PPO is flattening, but I think overall still looks great. We're going to get a 20-day test at some point, and that would be the next key solid reward to risk entry point into transports. All right, looking at the chart of the day. First, if you like the chart of the day, please go over to earningsbeats.com. I take time out of my day 3 times a week. This is free. I do it to give back, to try and teach some of the things I've learned over the years. Again, it's free. It's designed not to be, it's not designed to be your trading go-to to find a stock to trade every day or every other day. It's more about hopefully providing folks a little bit more in their technical toolkit, some of the things to watch for, to look at, to maybe be fearful of or to be cautious of. It's all of those things. But right here, all it takes is a name and an email address. It's completely free. There's no credit card required. You can unsubscribe at any time. Name and email address. It comes out 3 times a week, Mondays, Wednesdays, Fridays. It's a very quick read. It's not like you're going to be getting inundated with this thing. It's going to take you an hour to go through. It'll take you maybe 2 or 3 minutes. 2 paragraphs and a chart. So check that out. If you haven't already subscribed, please do. We also have free events from time to time at Earnings Beats. And if you're on this list, we will send you room instructions. You don't have to do anything. Just be on this list and you'll get room instructions to all of our free events. Let's see, what else do we have? I do want to welcome those of you who have found us on the YouTube stream, our live stream. Please make sure you like our videos, subscribe to our channel, and then make sure your notifications are on so that when we do events that we live stream, you'll be notified. You can come in and join if you can. If not, you can always check out our videos. We'd love to have you, but we do view this as our entire Earnings Beats community. And so we would love to have you on here. We did change our schedule recently, so I want to make sure I want to announce this every once in a while. So we are now doing these live, these free shows Tuesday, Wednesday, Thursday, 9 a.m. every day, generally till 9:30, might go a little bit longer, but generally 9:30. And then we wrap up. On Wednesday, we have a live trading room that starts at 10 a.m. for members only. And we have a 30-day trial. You'll see it right here at our homepage. Start your no-cost trial. Had a couple of really good trades that we talked about last week with folks that were in the room. 2 of the trades I took on personally, I'm still in them. They're up a little bit. I don't know, maybe anywhere 2-3%, something like that. But that's with the market that's been going mostly sideways. And there were a couple others we mentioned in the room that took off immediately after we talked about them. One of them was Tilray. I don't know where Tilray is now, but it was like right around $2. I think it pulled back temporarily to about $1.92, $1.95. I don't know, somewhere in there, and then hit 230, literally within a day or two. So we have all kinds of trades, a couple of things we talk about, lots of things we talk about actually in the room, and that will be tomorrow at 10 a.m. And again, it's for our paying members, but you can come in if you're a trial subscriber, and the trial is free. So check all of that out, please. Chart of the day today for the show. I wanted to show you the Financial Administration Index. I actually put this in the daily market report yesterday for our members. I think this group is definitely turning a corner. I pulled up a long-term chart because if you look back at a year or even go back a year and a half, you just see this group that has just been steadily going lower and lower and lower. And like all the folks that were talking about breadth and how the market wasn't, the large part of the market wasn't participating, there was no perspective involved. They were only looking at this very short time frame. And if you did that with financial administration, you'd look back and say this group never goes up. So that's why I did a little bit longer term chart, because you can see that it can have an extremely bullish run. And if you're in on it, you're going to do really well on whatever trades you have in that area. I think this one's turning the corner for a couple of different reasons. First of all, you can see the PPO is the strongest it's been since all the way back in August of last year. I think the overall market is proving that we are back into a secular market, a bull market advance, as opposed to a cyclical bear market decline, which is what helped lead this to the downside for the most part in 2022. So, and the money rotating, we've seen it go from areas that were leading into areas that were not performing. 2 months ago, industrials, no one wanted to touch industrials. Industrials made the breakout, took off. Transports, everybody said, well, transports aren't doing anything. Bull market's in trouble. Then the transports took off. Well, if you're looking at this chart, I think it's just now starting to move to the upside. If you look at the AD line, very, very strong. While it was going down and setting new lows the last several months, look at the AD line. So it went down, the AD went down during the cyclical bear market. But once June hit, right here, this is when I said things started to change in the market, even for groups that kept going lower. I can still see bullish undertones in these charts. And now we're starting to see a little bit of movement to the upside. Not a lot, but it's got to start from somewhere. We're starting to turn up on a relative basis. I really want to make this breakout about 535 to 540. And if that happens, I think this is a group that could have a really strong year ahead. So watch the financial administration stocks. All right. Last thing I want to talk about, we've been talking about small caps. I want to show you a little bit more that you at least need to be aware of. So here's a relative rotation graph. Now, if you look at this, and what I've set up is the principal small cap index, and then all of the principal small cap sector funds. So these are all small cap funds within these various sectors. So you've got PSCE Energy, PSCD, actually you can see it down below here, so I don't need to go through all of these, but they're all shown down here at the bottom. And a couple things I want to point out here. So if you look weekly, 1 year weekly, you can look over here. Everything from left to right is relative strength. So anything over here on the far right, the leading, this is going to be the areas that have shown the best relative strength over the course of the last year. And this is where we've been. This is what's called the tail. And so you come down here and you do the tail length by moving this back and forth. So if you wanted to see where this has gone from, 13 weeks, the last quarter, look at what technology has done. It has shown so much relative strength. And now it's starting to weaken a little bit, but it's still way out here to the right. So it's still showing a lot of relative strength. It's just not quite as much as it was showing before. So we're seeing a little bit of a pause there. And you can see some of the areas that have been beaten up pretty good. But I want you to focus on two groups that have really started to improve: small cap energy, small cap financials. These two areas are big time moving to the upside. And if you want to know why the IWM is running the way it is, I'm in here in the composition. This is over at Fidelity. And I pulled up the IWM. You can go in and look at ETFs. And if you click on the composition, what it'll show you, number one, is top 10 holdings. The number one holding in the IWM is less than 0.5%. And only a few stocks are more than 0.25% of the IWM. So the first takeaway with the IWM is that it is an extremely diversified ETF. Hundreds and hundreds of companies. IWM, Russell 2000, 2,000 companies, right? Very, very diversified. I could look at all the holdings by weight, but they're all going to be pretty similar, right? But here are some things to look at. Industrials. Remember, industrials just recently broke out. I've said small caps have been doing better. Industrials are 17% of the IWM. Financials are 15% of the IWM. So that's almost a third in industrials and financials, which are a little bit more value oriented. And then you look at energy. Energy is probably at least twice weighted what the S&P 500 is. And so it starts to make sense when you look at the rotation and you see energy and you see financials, momentum. This left side, the vertical axis here, this is momentum. If you're going from from bottom to top, you're getting stronger in terms of momentum. Energy, strengthening in momentum. Financials, strengthening in momentum. Here are industrials just kind of hanging out over here, going a little bit in a circle, but it's on the relative strength side, and it's kind of like even momentum. Technology is above the center line in momentum. Technology, industrials, energy, financials. Go back and look at this list again. Industrials, financials, technology, and discretion, and energy. 4 of the top 6 are performing really well, or at least a lot better, on this relative rotation graph. And you could switch this to, say, a daily and just see what's really been moving recently. Energy, financials. If this is now 1 year daily, and we can shorten that to 5 trading days a week. But look at what's going on here. Extremely bullish action in 2 areas that matter a lot to the IWM. So if I come down here to industry exposure, check out the industry. Banks have been on fire recently if you haven't been paying attention. Biotech, not so much. We really haven't seen the biotechs move yet. That would be another area that if it started to move, that would really help the IWM. Software has been strong all year. There's your oil and gas. There's your energy. Machinery, that's industrials. Semiconductors have been on fire, but you can kind of get an idea by industry exposure, sector exposure, why the IWM wasn't doing well for a while and why it's doing better now. So kind of take a look at those areas. And as long as they continue to improve, the IWM's got room to run. And so when we look back, take a look at, say, look at the IWM. This move to the upside, watch that 20-day moving average, because if we pull back and hit it, I think we're likely to bounce right off of it. I actually like it right at, where we are. And we did just open, by the way, we're a couple minutes in, so I'll wrap this up. But we are down right now about 1% on the IWM. So if we get closer to that 20-day moving average, keep an eye on that, because I believe we bounce off of it and move higher with the IWM. I don't even know if we go back down that far, but we'll see. Let's take a look and see what is leading to the downside. So we do have small caps leading after or lagging today after leading yesterday. We got the NASDAQ down about 0.5%, S&P not much less than 0.25%. Now we got the Dow, money rotating back into the Dow a little bit. Caterpillar out with earnings, leading the Dow Jones up 4%. I think Merck, and I know Merck reported as well, so they're up 2%. Down, not really a whole lot going down today. Let's look at the S&P. Zebra down 14%. Oh, this is an interesting one. Norwegian Cruise Lines. This actually could be an opportunity. I like Royal Caribbean better, RCL, but this is in a space that's been very hot. If they beat top and bottom line, and I don't know because I haven't looked just yet, but if they beat top and bottom line, this move down could be an opportunity today for this stock because it is in a very, very strong group. Percentage moves up. Let's see, ANET up 12%, Global Payments 6%. Just looking down the list, not really a whole lot of other. I was looking for growth names, not really seeing those. So it just seems like maybe just a little bit more rotation is what we're looking at right now. Anyway, that's it for me. I appreciate you tuning in. I'll be back here again tomorrow, 9 a.m. Please make sure you like the video and subscribe. We want to make sure that you are notified if we have any of these free events. Get used to this 9 o'clock start time, Tuesday, Wednesday, Thursday. We will be doing it right here every single day. And we have our live trading room on Wednesdays at 10 a.m., but you do need to be a member for that. Everybody have a great day. Happy trading. And we'll be back tomorrow morning. See ya.